Grand Portage Resources' Herbert Gold Project in southeast Alaska highlights increased gold resource, indicated and inferred, of 860,000 ounces, in excess of 10 grams per ton gold. Expansion drilling is planned on the Herbert Gold property for the summer of 2019. Grand Portage Resources trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Well, you know, Jim, I always look forward to our Friday morning get-togethers.
Bob, I have a feeling we're going to hear from Cicero here in a second because the stock market in Pakistan has just packed it in.
It has been packing it in. I know, I looked at it, and it's given up 50,000 points since its peak in 2017 at 53,000, and it's around recent low was 3,300. So you can say their leading index has given up 50,000 points. But also in looking it up, in 2016, they'd had an outstanding year. That index was up 46%. So what you've got here, Jim, is an outlying exchange that had a fabulous bubble, blew itself out, and has been contracting ever since. So it's an example for other outlying exchanges, such as, I used to call them lesser exchanges, but when you got a market and an economy as big as China's, you can't say that's a lesser exchange, but you can call it an outlying exchange in that it is outside of the two main markets, of course, are London and New York. New York being, for the last, since the 1930s, no, since after the war, the senior capital market, the financial capital of the world. But London is still very important. So then history, and as you mentioned, Cicero, 2,000 years ago, he was a good writer and he had a good eye, and he pointed out that if you had financial problem in an outlying market such as the Middle East, I think he called it the Orient then, so Phoenicia or some places, they were trading cities there with financial markets, and if you had a problem in the outlying market 2,000 years ago, and he writes, it inevitably comes in and hits the financial center. So this is well underway. There's no way you can fix these things, because in Turkey, for example, we've got disturbing stories from there this week. Their central bank runs out of the main reserve currency, which is U.S. dollars, and in order to hold those, they have to raise rates, and money market rates, and that pushes asset prices down, but it's all one associated event. So then the next question is, when's it going to hit New York and London? Well, when do they usually hit? In the fall. So we're just now watching for the yield curve to do one more move. Let's call it the second breakdown. The first one has already been done. And then on credit spreads, which is the difference between high-grade and low-grade bonds, it's had the second breakout on reversing to widening. And in this kind of a market, either or both of these reversing would be a warning. So you have then now on the credit spreads, we use the CCC rated bond index relative to treasuries. and it is at 9.98 or something like that, and the second breakout would be just sort of like 10.03% yield, just so it's close. And it's worth noting that in 2007, that second breakout came, I think, around July 20th. And then the stock market had its peak in the middle of October. And then you had the start of that contraction and bear market and recession. And then the establishment, which had been in September of 2007, saying that no problems because the Fed was going to cut rates. And there was a problem because asset prices crashed and short rates went up, which they always do. Short rates went down. Sorry, the T-bill rate went down, and then the Fed followed. So that's typical. So it's similar to what was going on in the summer of 2007. And we watch it with fascination because, every day you get a quote on your credit spreads or the yield curve, and you look at it on the chart and say, yeah, here it is. This pattern is developing, and it is the pattern that leads to a contraction. And then you go back and say, now, when do you usually discover some liquidity problems? Well, it's usually in the fall of the year. So this is looking, well, it's within the pattern, Jim, and there's two ways of going about it. You can say, hey, this is really off the pattern, and everything's going to be fine. Or you can say, hey, it's within the pattern, which makes me concerned, and maybe I should take a little money off the table. And that's our view on that.
We'll have more with Bob Hoye right after the break.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're chatting with Bob Hoye. A reminder, we have a couple of listener questions we'll get to towards the end of the show. But earlier this week, we had the S&P hit another record high. The stock markets in the U.S. looking like they're strong again to close out the week. The Canadian stock market down. Bob, how long can this charging market in the U.S. be sustained?
Well, that's what we're here for, and we got the technical readings on it. But on you prompted me this morning. I wrote down a quote from a financial news site today. Another day, another record on the Dow Jones. So this is important because the Dow Jones and the S&P are made up of stocks that the world will buy. These are your big name stuff, and the world is buying them because the Fed is talking, or the street is talking about the Fed's going to lower rates, and this gets twisted all around. They take it as positive. But all throughout commercial history, in a boom, short-dated rates like treasury bills go up, and in the bust, they go down. And the 3-month treasury bill rate reached its peak in March, actually, and has been coming down. It is down distinctively. So it's all, Jim, and we got to put in that the T-bill rate is a market rate of interest, and it's being adjusted by traders all of the time. Traders, participants, investors, everybody. And when you're in interesting times like now, the Federal Reserve has followed the change in interest rates. In 1929, for example, the 3-month bill went up until June and then turned down, and it was down quite significantly by the time you got to the fall. And then in October, the Federal Reserve lowered its rate, so it was about 5 months behind the action. So this is, it is so blatantly wrong for the street to be bidding up stocks on the prospect of the Federal Reserve lowering its administered rate. And one more irony on this one, Jim, is that when these short rates come down in a liquidity problem, the more severe the problem, the faster the short rate goes down. So this is a death trap for those who are buying the stock market now on the prospect that the Fed's going to cut rates. I got a wonderful quote on that in September 2007, and we wrote a couple of paragraphs on it that this ain't going to happen. So I think, Jim, when the T-bill rate is going up in yield, it reflects a growing demand for speculative money. And then when it stops going up, and this is just sort of a rough kind of guess, Jim, that the demand for speculative money is diminishing. And then when it really goes down, that's your very careful money, wants to be in a safe place, liquid, where it can get its money back. And of course, 1 year and shorter treasuries is very liquid. It's the most liquid place you can find. So when they drop sharply as recent, I think that's a sign of people positioning, careful money, positioning in liquid items. And then, of course, the other liquid item is gold, but that's a separate story. We can talk about that one later. But so the declining T-bill yield is a fact. It's important. And the official chat about the Fed lowering rates is that it's a bullish item is completely erroneous. It's just plain wrong thinking. They've got cause and effect all screwed up. But what you've got is that there are very many people with this kind of education running money, big funds, sovereign funds, all kinds of funds. And where do they put their money? In the New York stock market, because it's the most liquid stock market. And what do you buy? Well, of course, the most liquid stocks, which are S&P 500 stocks and Dow Jones stocks. So this is why the S&P and the Dow are making record highs. But you take an index of the New York Stock Exchange Composite, which is 2,000 stocks or something like that. Well, it's been rising since the dismal December, but it's not to new highs. That one set a huge high in January 2018, which is quite a while ago. So you've got two markets out there, the institutional favorites in the S&P, and the institutions are buying for the wrong reason, Fed funds, nonsense. And then you've got the broad market, like the New York Stock Exchange Comp, not new highs. The transports are not new highs. And then also there's an index of World Stock Index without U.S. market in it. And it made its big high in January 2018 and is nowhere near making new highs now. So I think the action and my headline from this morning of another day, another record high, that's isolated event, I believe. Just strictly institutional grade stocks, and they're buying for the wrong reasons.
We'll be talking gold and silver when we answer 2 listener questions when Bob Hoye returns.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, our first listener question, can silver be considered a safe haven?
That's, who did we get that one from?
I don't think we have a name.
Oh, okay. Anyways, that's a good question. And the silver, they often say, is the poor man's gold. And when you're in a bull market for gold and silver will always outperform gold. But for the last year or so, silver has been underperforming gold. So we're not in a bull market for precious metal. We've had a nice rally out of the stocks, which is the sector I favor. We had our accumulate on weakness for the 1st of November, and the market did take a down tick and into the middle of November, and then you've had a very worthwhile rally since in gold stocks. Now, the problem with silver is 2 things. One, you've got generations of silver bugs have analyzed that every year there's a shortage in silver supply, and this we call fundamental research, supply-demand. And they use this to figure that silver's got to go up. And no, silver is a financial item, and the gold-silver ratio acts like a credit spread. And in a good boom, and when the precious metals are moving, silver will outperform gold. But you're not in a boom, silver underperforms gold. And indeed, when the gold-silver ratio goes up or gets volatile, it's been rising all year, that's a warning that there's financial problems around. So in direct answer to the question, perhaps if there is some financial problem discovered after August, one of the alerts on that, Jim, would be silver doing a sudden plunge relative to gold, and that's happened in previously disturbed financial markets. So, good question, and we would not have, I wouldn't be owning silver as a metal, and I'd be lightening. Well, there's some of the silver stocks rally, but not as strong as some of the gold stocks. But one could lighten up on both gold and silver stocks, as we've got this strength now.
Chris from Rhode Island writes us, "Hi, Bob. I'm a longtime subscriber and want to thank you for sharing all your work over the years. Regarding the gold price, I'd like your perspective on the following. Back in 98-99, the UK famously sold off their last ounces of gold at the bottom. Canada did the same thing, by the way. Today, many central banks are buying aggressively. Should we expect this buying to be a contrarian indicator? And what does financial history tell us?"
Chris, thanks for the question. Yeah, the contrarian indicator is that if the central bank is buying, they got to be wrong. And I don't think so. This is a changed world. The ideal reserve for any, like a bank, commercial bank, investment bank, or even a central bank. The ideal reserve is gold. And it shouldn't be managed like a portfolio. So the Central Bank of England and the bank sold in 1998, that was a leftover from the long-term capital markets, LTCM, a highly leveraged fund managed by a highly respected theoretist. And it got into trouble. And the credit spreads went against them, and it was a horrendous crash. So within that, I believe that the fund might have been short gold. And so the answer was to cover that, because central banks had loaned money directly to this highly aggressive fund. And indeed, I recall the Bank of Italy had even had an equity position in the fund, and the fund collapsed, disappeared, $4.5 billion hit. And so the Brits selling gold, the central bank was selling, not the public, and it was selling to solve a problem with long-term capital management. Now, at the same time, Canada was selling its gold down to zero, and at the time I believe that was doing the establishment a favor, and they were attempting to get on the group of 7 or 8 or 20 or 15.5 or something like that. So there were some political dealings there, and you should understand that central bankers and interventionist economists can't handle gold. They just don't understand it. It's their enemy, it's their nemesis, and actually, in the ultimate analysis, gold is money, and it does what it does through a financial bubble, and that in relative terms, like deflated by the CPI, the real price of gold has come down in a bubble, and it has, and it appears, Jim, to be stabilizing now as this bubble appears to be on its last legs. And if we go into financial problems in the fall, the real price of gold will go up, but the problem will be is that gold stocks could get sold off. But it's working towards another major bull market for the golden sector, and we're looking forward to it.
Bob, thank you so much for being on the show.
Well, here we are, and it's good to be with you.
And if you're a person from Rhode Island or anywhere else on our little blue planet, you're invited to ask Bob any question you like at info@HowStreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.